Hello and welcome back to our channel. As we all know, the US car market is one of the largest and most competitive in the world, with a wide range of players vying for a piece of the pie. Over the past few years, the market has seen some significant changes, and 2023 is shaping up to be another transformative year. The market has seen a decline in sales and an increase in prices, which are creating challenges for the industry. Leading industry experts are foreseeing a huge crash in prices in 2023 as inventory starts to increase in dealers and prices of electric vehicles continues to drive down. Believe it or not, it has never been cheaper to buy a Tesla. According to Bloomberg News, average prices are $5,000 cheaper than the average US car. If you think that means you can get a cheap EV, think again, as rising finance rates already put the average monthly payments for vehicles at $650. There are plenty of challenges in making car prices affordable in the United States market, and in this video, we'll break them down for you. Stay tuned! But before we start, we'd like to ask you for your support by giving this video a like and subscribing to our channel. First, let's take a look at some of the trends that are currently shaping the US car market. One of the most significant trends we're seeing is the shift towards electric vehicles, or EVs. In 2022, EV sales in the US surpassed 2 million for the first time, and that number is expected to grow even further in 2023. This is partly due to government incentives for EVs and growing awareness of the environmental benefits of electric transportation. Another trend we're seeing is the rise of autonomous vehicles, or AVs. Although fully self-driving cars are still in development, many cars on the market today have semi-autonomous features like adaptive cruise control and lane keeping assistance. In 2023, we can expect to see more of these features become standard on new cars, as well as more testing of fully autonomous vehicles. Finally, we're seeing a trend towards smaller and more efficient cars. As fuel prices continue to fluctuate, many consumers are looking for cars that offer better gas mileage. This has led to a resurgence of smaller cars like the Toyota Corolla and Honda Civic, as well as an increase in hybrid and plug-in hybrid vehicles. Especially this last trend is the complete opposite of what has been seen in the car market in the US over the past decades. This market has been known for having big, opulent models that paid no attention to gas consumption. The rising prices in gas, coupled with the shrinking purchase power of the middle class, has led to an even greater change in car trends that can be seen in any dealers throughout the country. The biggest challenge facing the US car market in 2023 is the decline in sales. According to industry reports, car sales in the US have been declining since 2017, and this trend is expected to continue in 2023. There are several reasons for this decline, including changing consumer preferences, economic uncertainty, and the ongoing pandemic. Also, the ongoing semiconductor shortage is changing the pace at which manufacturers can deliver vehicles. This has led to production delays and even plant shutdowns for many car manufacturers, and it's unclear when the shortage will be resolved. Another challenge is the increasing cost of raw materials like steel and aluminum. This has led to higher prices for new cars, which could potentially dampen demand. Additionally, the ongoing labor shortage is also affecting the industry, with some manufacturers struggling to find enough workers to keep up with production demands. Another factor affecting the car market is the rise of subscription-based car ownership. Instead of buying or leasing a car, some consumers are opting for subscription-based services like Care by Volvo or Porsche Passport. This model could potentially disrupt the traditional car ownership model and create new opportunities for car manufacturers and dealerships. But in the meanwhile, while they have not adapted to this change and consumers are still divided whether this works or not, this model affects the supplier side by reducing the stock of available new units while pushing the used car vehicles as subscription-based companies renew their fleet. As a whole, all these factors have been increasing the demand for used cars in the United States, which in turn have seen prices skyrocket as of recent months. CNBC reported that wholesale used vehicle prices increased 4.3% in February from January, marking the largest increase between the 2 months since 2009. They also claimed that despite the prices were actually lower than 2022, they are trending back towards record high levels. The Manheim Used Car Vehicle Index has taken an upward trend after falling for the past 12 consecutive months. Moreover, every segment has shown an increase: car, SUVs, trucks, vans. Manheim is concerned that sellers have increased pricing power than what is typical for this time of year. This unreasonable strong increase is bad news for consumers looking to score a good deal, as well as for the Biden administration, which has been using used car prices as a meter for reducing inflation. The CNBC report continues to state that the average listed price of a used vehicle was $26,510 in January. and that the used vehicle retail sales declined 54% from January to February and were down 9% from a year earlier. The final blow on the market has been delivered by rising interest rates in financing. Higher interest rates means vehicles become less affordable for consumers who have been dealing with record-high new and used vehicle prices for several years now. Since the start of 2022, average vehicle interest rates have been on the rise, 1.77 percentage points for a 60-month new car loan and 1.78 percentage points for a 48-month used loan, according to a national bank rate survey of rates. That means on a $30,000 loan, you're going to pay an extra $8,000. However, interest rates aren't likely to go down soon. According to the Federal Reserve, interest rates increases are expected throughout the year, thus impacting auto loans. On the opposite direction, manufacturers have seen their stock prices increase as much as 26% from January. This includes GM, Ford, Stellantis, Sonic, CarMax, and Lithia, which is bound to create an imbalance in the industry. And that is the turning point of the entire market. Prices dare to stay at almost record highs even with reduced demand. The Biden administration doesn't show any signs to reduce interest rates. Manufacturers are bound to reduce the requirements in order to increase sales and thus offer credit for subprime customers. This is creating a bubble that, once burst, could send the entire market on a downward spiral. What do you think? Have you tried buying or selling a car lately? We look forward to reading your thoughts in the comments below. Thanks for watching.